BMO warns. Silver's 47% surge overdone. Crash coming? Silver just hit levels not seen since 2012. A 47% surge that has traders celebrating. But one of the world's largest banks just issued a warning that could change everything. BMO Capital Markets sees something the crowd is missing, a pattern that's been repeating since the 1970s, a growing surplus that could reverse this entire rally. The gold-silver ratio sits at 50. History says it won't stay there. And when it moves, fortunes will shift. The question isn't if the crash is coming, it's whether you'll see it before it's too late. Welcome to Currency Alert, where we decode the financial signals that matter to your wealth. Now, if you've built your career on making informed decisions, if you've spent decades learning to spot real opportunity from market noise, then you understand the value of analysis that cuts through the headlines. Do us a favor, hit that subscribe button below, not for us, but for yourself, so you never miss the warning signs that could protect what you've spent a lifetime building. And tell us, where are you watching from today? New York, London, Dubai, Mumbai? Drop your city in the comments. Let's see how global our community of serious investors truly is. Now, let's examine exactly what BMO Capital Markets discovered and why their 5-decade analysis suggests this silver rally may be living on borrowed time. When silver prices surge to record highs, most investors celebrate. But when one of North America's oldest banking institutions issues a public warning during that same rally, experienced market participants pay attention. This is precisely what happened when BMO Capital Markets released an analysis that contradicted the euphoria sweeping through precious metals markets in early 2025. Silver had just completed a remarkable ascent. The white metal climbed to levels not witnessed in over a decade, fueled by a combination of geopolitical tensions, monetary uncertainty, and what analysts were calling unprecedented retail investment demand. The numbers told a compelling story. A 47% surge that transformed silver from a quiet industrial metal into one of the year's most talked about assets. But beneath the celebration, a critical market indicator was flashing a signal that historical patterns suggested could not sustain itself. The gold-silver ratio had compressed to 50. For those unfamiliar with this metric, it represents how many ounces of silver are required to purchase 1 ounce of gold. At 50, this ratio had reached its lowest point since March 2012, a period that preceded significant market adjustments. BMO's analysts did not share the market's optimism. Their research pointed to something the crowd was missing. They examined 5 decades of data, tracing patterns back to a pivotal moment in monetary history, the end of the Bretton Woods system in the early 1970s. This was when the United States severed the dollar's link to gold, fundamentally transforming how precious metals traded in global markets. What BMO discovered in that half-century of data was revealing. They identified what they described as a strong causative relationship between physical silver surplus and the gold-silver ratio as direction. When supply exceeded consumption by significant margins, the ratio consistently expanded. Silver underperformed gold. When surplus conditions reversed, the ratio compressed. Silver outperformed. The pattern had repeated itself through multiple economic cycles. The stagflation of the 1970s, the technology boom of the 1990s, the financial crisis of 2008, the pandemic disruptions of 2020. Each period demonstrated the same fundamental relationship. Physical surplus drove ratio expansion. Physical deficit drove ratio compression. Current market conditions, according to BMO's analysis, were building toward a surplus environment. This was the core of their warning. The bank's commodity strategists projected that in the coming years, silver supply would increasingly exceed consumption. This growing surplus would inevitably pressure the gold-silver ratio upward, meaning silver would underperform gold. The timing of this warning carried particular significance. It arrived precisely when market sentiment had reached extremes. Social media platforms were filled with bullish silver commentary. Retail investors were piling into silver-backed exchange-traded products at record rates. The metal had developed characteristics of what BMO diplomatically termed a meme investment, drawing comparisons to speculative frenzies in other asset classes. Geopolitical uncertainty was adding fuel to the rally. Tensions in the Middle East, trade conflicts between major economies, central bank policy divergence. These factors created an environment where investors sought tangible assets, and silver benefited from these flows alongside gold. But BMO's analysts made a crucial distinction. They separated short-term demand drivers from long-term structural fundamentals. Investment flows, they argued, were temporary. Geopolitical premiums were temporary. Meme-driven speculation was temporary. What persisted across decades was the relationship between physical supply, physical consumption, and price performance. The bank introduced a metric they considered more reliable than tracking investment demand. They urged market participants to focus on the balance between silver consumption and silver supply. Consumption included industrial applications, jewelry manufacturing, and silverware production. Supply represented mining output, recycling, and secondary sources. Historically, supply exceeded this consumption aggregate. The surplus went into investment holdings, government stockpiles, and inventory builds. When these surpluses grew large, prices struggled. When they contracted, prices rallied. The current environment, BMO suggested, was transitioning from a deficit or balanced state into surplus territory. This analysis presented business leaders and serious investors with a framework for evaluating Silver Eag's prospects that differed sharply from the prevailing narrative. While the crowd focused on the 47% gain and projected further upside, BMO's 5-decade pattern recognition suggested the opposite. The ratio at 50 was not a new normal. It was a temporary deviation that historical precedent indicated would correct. For entrepreneurs and business owners considering silver exposure, this created a strategic dilemma. Price momentum remained strong, media coverage remained bullish, retail participation continued expanding. Yet one of the world's most established commodity research teams was stating plainly that the current trajectory was unsustainable. The warning was explicit. While very short-term factors might push the ratio lower temporarily, the medium and long-term outlook pointed toward ratio expansion. Silver would underperform gold as surplus conditions materialized. The trend that had governed this relationship since the 1970s would reassert itself. Understanding why BMO reached this conclusion required examining the specific supply and demand dynamics they identified, particularly in the industrial sector that consumed the majority of silver produced globally each year. August 15, 1971, represents a watershed moment that most business professionals overlook when analyzing precious metals markets. On that summer evening, President Richard Nixon announced the United States would no longer convert dollars to gold at the fixed rate of $35 per ounce. The Bretton Woods system, which had governed international monetary arrangements since 1944, collapsed overnight. What followed was not merely a policy shift, it was a fundamental transformation in how silver and gold behaved as financial assets. For the first time in modern history, both metals floated freely against fiat currencies without government-imposed price controls or conversion guarantees. This created a natural laboratory spanning 5 decades, and BMO Capital Markets had studied every data point within it. Their findings revealed something market participants consistently underestimated. The physical surplus of silver, measured as the difference between total supply and actual consumption, possessed predictive power for the gold-silver ratio's direction. This was not correlation. BMO's analysts used the term causative relationship deliberately. Surplus drove ratio expansion. Deficit drove ratio compression. The pattern held across wildly different economic environments. Consider the mechanics underlying this relationship. When mining companies produced more silver than industries consumed, the excess metal had to find a home. Some went into investment products. Some accumulated in vaults. Some sat in inventory at refineries and dealers. This surplus represented latent selling pressure. It depressed silver's price relative to gold, which faced different supply-demand dynamics given its primary role as a monetary asset rather than an industrial commodity. The 1970s provided the first test case. Following Nixon's decision, both metals surged as inflation expectations exploded and dollar confidence collapsed, but they did not rise in lockstep. The ratio moved from roughly 40 in 1971 to peaks above 100 by the end of the decade, as silver production ramped up faster than industrial demand could absorb it. The Hunt brothers' attempt to corner the silver market in 1980 created a brief deviation, but once that speculative episode collapsed, the surplus-driven ratio expansion resumed. The 1990s technology boom offered a contrasting scenario. Silicon Valley's rise drove enormous industrial demand for silver in electronics manufacturing, photography, and emerging applications. Consumption growth outpaced supply growth. The surplus contracted. The ratio compressed from levels above 80 in the early 1990s to below 60 by the decade's end. Physical fundamentals governed price performance despite this being an era of equity market dominance. The 2008 financial crisis brought yet another variation. Initially, both metals sold off as liquidity evaporated across all markets. But in the recovery phase, silver dramatically outperformed gold. The ratio plunged from above 80 in 2008 to below 32 by 2011. What drove this? A combination of investment demand and legitimate consumption growth from solar panel manufacturing and other green technologies. The surplus that had characterized the early 2000s evaporated. Deficit conditions emerged. The ratio compressed exactly as BMO's historical framework predicted. This brings the analysis to 2025 and the current compression to 50. BMO's strategists saw this level as historically significant but unsustainable based on their surplus projections. The bank was not making a subjective judgment. They were applying a framework that had demonstrated explanatory power across 54 years of post-Bretton Woods data. Their concern centered on what they termed the better metric for evaluating silver's outlook: Rather than tracking investment flows, which were notoriously volatile and sentiment-driven, they advocated monitoring the balance between consumption and supply. Consumption meant real economic usage. Industrial applications in electronics, solar panels, medical devices, and automotive components. Jewelry demand in India and other major markets. Silverware production for both industrial and consumer purposes. Supply represented mining output from primary silver mines and as a byproduct of copper, lead, and zinc operations. It included recycling from industrial scrap and old jewelry. It encompassed government sales from strategic stockpiles when they occurred. The supply typically exceeded consumption by a margin that varied from year to year, but remained positive in most periods. The current rally was being driven overwhelmingly by investment demand. Exchange-traded products saw record inflows. Retail buyers purchased physical coins and bars at unprecedented rates. Social media platforms amplified bullish narratives, creating what BMO carefully described as meme investment characteristics. This was demand divorced from industrial consumption trends. Geopolitical uncertainty added another layer. When tensions escalated in the Middle East, when trade wars threatened global commerce, when central banks pursued divergent monetary policies, investors sought havens. Silver benefited from these flows alongside gold. But BMO's analysts considered these temporary factors. Geopolitical crises eventually resolved or were priced in. Meme-driven speculation eventually exhausted itself. What persisted was the structural relationship between how much silver the world produced and how much it consumed for actual economic purposes. The banking institution's projection was unambiguous. They forecasted a growing surplus of physical units in coming years. The surplus would exert downward pressure on silver relative to gold. The ratio would expand from its current 50 level. Silver would underperform. The trend that had governed this market since the 1970s would reassert its dominance over temporary sentiment-driven distortions. For business leaders allocating capital, this represented a clear framework for evaluation that contradicted the prevailing market narrative. The gleaming solar panels stretching across deserts from California to the Gobi represent one of humanity's most ambitious energy transitions. For silver markets, they also represent what may prove to be a historical peak in industrial demand that will not repeat itself. This is the conclusion that separates BMO Capital Markets from the consensus, and understanding why requires examining the intersection of technology, manufacturing economics, and Chinese industrial policy. Silver's role in photovoltaic cells is both critical and economically vulnerable. The white metal serves as the primary conductor in solar panels, forming the microscopic grid that captures and channels electricity generated when sunlight strikes silicon wafers. For years, this application drove extraordinary demand growth. Solar installations multiplied across continents as governments subsidized renewable energy and manufacturing costs declined. Silver consumption from this single sector surged from negligible levels in the early 2000s to becoming one of the metal's largest industrial applications by the 2020s. But BMO's commodity research team identified a turning point that most market participants had not fully internalized. Solar demand for silver had likely peaked, not because solar panel installations were declining. Global solar capacity was still expanding. The issue was more subtle and more consequential for silver's supply-demand balance. The amount of silver required per panel was falling faster than panel production was rising. Manufacturing efficiency had improved dramatically. Engineers developed techniques to apply thinner silver paste to solar cells without compromising electrical performance. Industry data showed silver content per panel had declined by more than half over the previous decade. This trend was accelerating, not slowing. Research laboratories in China, Europe, and the United States were developing copper-based alternatives in novel architectures that could further reduce or potentially eliminate silver usage entirely. China's role in this transformation cannot be overstated. The nation dominated global solar panel manufacturing with market share exceeding 70%. Chinese factories operated at scales that enabled rapid implementation of material-saving innovations. When engineers discovered methods to reduce silver loading by even small percentages, those savings multiplied across hundreds of millions of panels annually. The aggregate impact on global silver demand was substantial and structural. This created a paradox that confused casual observers of silver markets. Headlines celebrated record solar installations. Environmental policies worldwide mandated accelerated renewable energy adoption. Yet the silver intensity of this growth was diminishing quarter by quarter. BMO's analysts recognized that tracking panel shipments provided misleading signals about silver consumption. The relevant metric was grams of silver per gigawatt of capacity, and that number was in sustained decline. The timeline for alternative technologies added another dimension to BMO's bearish outlook. Solid-state batteries represented a potential game-changer for energy storage, which complemented solar power deployment. These next-generation batteries promised higher energy density, faster charging, and longer lifespans than lithium-ion technology. They also utilized different materials that could shift industrial metal demand patterns significantly. However, commercial viability remained elusive. Laboratory prototypes demonstrated promising characteristics, but scaling to mass production at competitive costs presented obstacles that might take years to overcome. BMO's assessment was pragmatic. Until solid-state batteries transitioned from research to reality, silver would maintain certain industrial applications. But this did not change their fundamental view that solar's contribution to silver demand had peaked and would decline in absolute terms within the forecast horizon. The implications extended beyond solar. BMO projected overall silver supply increasing in coming years. This forecast incorporated responses from mining companies to elevated prices. When silver rallied 47%, it transformed the economics of marginal deposits. Projects that were uneconomical at $60 per ounce became attractive at $90. Exploration budgets increased, development timelines accelerated. Primary silver miners and base metal operations producing silver as a byproduct both responded to price incentives. Historical patterns supported this supply response mechanism. Previous silver rallies consistently triggered production increases that eventually overwhelmed demand growth and created surplus conditions. The lag between price signals and supply responses typically measured 18 to 36 months for projects already in development, longer for greenfield exploration, but the response itself was highly predictable based on decades of industry behavior. Secondary supply also merited consideration. At $90 per ounce, recycling economics improved substantially. Industrial scrap that was marginally worth processing at lower prices became profitable to recover. Silver content in electronic waste, photographic materials, and old jewelry justified more intensive recovery efforts. This represented additional supply entering markets without requiring new mining activity. BMO's synthesis of these factors produced a clear conclusion. Solar demand peaking, primary supply increasing, secondary supply responding to price incentives. The mathematical outcome was a growing physical surplus. This surplus would accumulate in vaults, inventories, and investment holdings. It would represent latent selling pressure that would eventually depress silver's price relative to gold. The bank's forecast that silver would underperform gold was not a subjective market call. It emerged directly from their supply-demand modeling, combined with the 5-decade historical relationship between surplus conditions and ratio expansion. For business owners evaluating precious metals allocations, this represented a fundamentally different analytical framework than the momentum-driven narrative dominating financial media coverage. The question was whether market participants would recognize these structural shifts before price action forced recognition. Thursday's trading session revealed something that experienced market observers find both fascinating and troubling. Gold futures stepped back from record highs, settling down 0.2% at $4,616.30 per ounce. Silver, meanwhile, climbed for the 5th consecutive session, adding 1.1% to close at $91.87. The divergence was modest, but the underlying dynamics were remarkable. Weaker than expected, United States jobless claims data had lifted the dollar that morning. Under normal circumstances, a stronger dollar pressures precious metals lower as they become more expensive for international buyers. Gold responded conventionally to this development. Silver did not. It absorbed the dollar strength, shrugged off traditional correlations, and ground higher despite headwinds that should have triggered selling. Robert Yawger, an analyst at Mizuho Securities, offered commentary that captured the unusual nature of silver's price action. He noted that silver was not trading lower on risk-off sentiment as relative calm had settled over the Iran situation. Geopolitical tensions in the Middle East, which had provided tailwinds for precious metals in previous weeks, were de-escalating. Markets were pricing out some of the geopolitical risk premium, yet silver continued climbing. Yawger made another observation that added to the puzzle. The United States government had declared it would not impose tariffs on critical minerals, including silver. This removed a potential bullish catalyst. Tariffs would have restricted supply and supported prices. Their explicit exclusion should have been a neutral to bearish development. Instead, silver ignored this information and extended its rally. The metal was, in Yawger's words, grinding higher despite factors that conventional analysis suggested should pressure it lower. This price behavior exemplified precisely the type of market environment that BMO Capital Markets was warning about. When an asset decouples from fundamental drivers and traditional correlations, it signals that sentiment and momentum have overwhelmed rational pricing mechanisms. Such conditions can persist for weeks or even months, but they contain the seeds of their own reversal. The business community faces a challenging task when markets behave this way. On one hand, price momentum is undeniable. Silver had delivered substantial gains. Traders who remained bearish based on fundamental analysis had lost money. The trend was clearly established and showed no signs of immediate exhaustion. On the other hand, institutions like BMO, with decades of commodity market expertise, were issuing explicit warnings that the current trajectory was unsustainable. This creates a strategic dilemma that separates experienced capital allocators from speculators. Speculators ride momentum until it breaks, hoping to exit before reversals inflict serious damage. Strategic investors evaluate whether current prices reflect long-term value or temporary distortions. BMO's analysis suggested the latter. Their forecast of inevitable ratio increase was grounded in 5 decades of post-Bretton Woods data, showing that physical surplus conditions consistently drove silver underperformance relative to gold. The timeline BMO specified carried important implications. They referenced coming years, not coming weeks or months. This was a medium-term structural forecast, not a short-term trading call. The bank acknowledged that in the very short term, geopolitical uncertainty and meme investment characteristics might push the gold-silver ratio even lower than its current 50 level. But they emphasized that growing physical surplus would ultimately overwhelm these temporary factors. For business leaders with silver exposure, this required careful position management. Companies holding physical silver as inventory or strategic reserves needed to evaluate whether current prices represented optimal exit opportunities. Entrepreneurs considering silver investments had to weigh the momentum narrative against institutional warnings backed by rigorous historical analysis. Financial advisors recommending precious metals to clients faced the challenge of explaining why a 47% gain might precede significant underperformance. The Bretton Woods pattern that BMO cited represented more than academic historical observation. It reflected a fundamental economic relationship. When industries produce more of a commodity than the economy consumes, surplus accumulates. That surplus exerts downward price pressure until supply contracts, demand increases, or prices fall sufficiently to clear the excess. This mechanism has governed commodity markets throughout human history. Silver was not exempt from these forces simply because investment demand was temporarily strong. BMO's distinction between trading sentiment and building sustainable positions deserves emphasis. Trading sentiment focuses on near-term price momentum, technical chart patterns, and market psychology. It can generate profits, but requires constant monitoring and quick exits when conditions shift. Building sustainable positions requires evaluating whether assets are priced appropriately relative to long-term supply-demand fundamentals. These approaches serve different purposes and require different risk management protocols. The current silver market presented a textbook case of markets pricing emotion rather than economics. Social media amplification, retail participation, geopolitical fears, and meme investment dynamics had driven prices to levels that BMO's structural analysis deemed unsustainable. History suggested that when such divergences occurred, economic fundamentals eventually reasserted themselves. The surplus dynamics that had governed the gold-silver ratio since the 1970s would, according to BMO's framework, overcome temporary sentiment-driven distortions. Strategic patience becomes critical in these environments. The temptation to chase performance is powerful when an asset has surged 47%. Fear of missing additional gains can override disciplined analysis. But business professionals who have built wealth over decades understand that preservation often matters more than participation in late-stage rallies. When established institutions issue warnings grounded in half-century empirical patterns, dismissing those warnings carries risks that extend beyond short-term opportunity costs. The question facing the business community was not whether silver could climb further in the near term. Momentum could sustain itself longer than fundamental analysis predicted. The question was whether positions sized for a structural bull market made sense when surplus projections suggested eventual underperformance relative to gold. BMO had provided their answer based on the longest-running empirical relationship in modern precious metals markets. How market participants responded would determine who recognized the warning before the inevitable correction arrived.